Ladies and gentlemen, welcome back to the channel. Tesla stock at the time of recording this video is pretty much break even, literally up or down a couple of cents. Elon Musk dropped big news today that should not go unnoticed. Now, we're going to talk about what's happening in the markets today. The S&P is up almost 1% right now. It's a very top-heavy market today. Like Nvidia and Microsoft and Apple and your other Mag 7 stocks that are carrying the index higher. At the same time, a lot of AI stocks and growth stocks and stock like a Tesla is not really doing the greatest today. I think this is about to change quite dramatically. But we'll talk about what happened today. We actually got really good news in the economic data. The big catalyst that we talked about yesterday for today came in better than expected. While that puts a little bit of pressure on the AI trade in the near term and the hypergrowth trade in the near term, it is great news. And we'll explain why in today's episode. We'll go over all of the headlines and everything you need to know. Do me a quick favor. All I ask is that you hit the like button, subscribe to the channel, and check that link out down below in the description of today's episode if you guys want to come join the trading community. We are buying stocks at dirt cheap valuations, growing at 300 to 500% next year. At dirt cheap valuations. It's crazy. The kind of deals you get during a market crash event, if you will, correction event, whatever it is we just went through, whatever you want to call it. The deals out there are dealing, okay? And we are stealing these stocks, basically. Check that link out down below in the description of today's episode. With that said, let's get started. Okay, so before we get into your Tesla stock specific news, I want to talk about what's happening in the broader markets today. If we take a look at the index, the Dow is up 0.86%, S&P 500 up 0.87%, NASDAQ up 0.97%, even the Russell up 0.80%. But it's one of those weirder days where not everything is going up. You know, today you have better participation than yesterday, but it's not a uniformly like super good day out there. Okay, especially for the AI stocks, the hypergrowth areas, the more risk-on trades are being slower recently to rebound from the corrective or crash phase that we just had in markets. Now, the VIX today is down about 6%, which that's important because the VIX is still elevated at 17.42. You're not down to some of the lower levels like a 14, 13, 12, something like that, where there's very little fear in markets. There's still a little bit of nervousness, but you are recovering. The fear is coming down, and you're seeing the maybe less recessionary areas doing a little bit better. More staple companies, right? But you are going to see a resurgence of the risk on trade. Okay? But we want to start seeing more economic data. There's still nervousness about where this economy is at, what the path ahead is going to look like for the Fed. Okay? Today, we had better than expected economic data in the catalyst that we talked about yesterday, which we got durable goods orders. They came in at 0.5% month over month. Expectation was 0.3%. This was for September. Okay. The bigger catalyst today was initial jobless claims because this is right up until November 22nd. This came in at 216,000 versus the expectation of 225,000. So this was better than expected. It did lower the odds of a rate cut for January. The odds of a rate cut for January as well as December, so 2 rate cuts at the next 2 Fed meetings, was 26% yesterday. It is 20% today. So Wall Street's saying, hey, we're going to get a cut December 10th. The odds of a cut December 10th actually went up about 2% today. So the initial jobless claims, or better than expected durable goods orders for September, did not change the odds of a December rate cut too much. It's pretty much a certainty we're going to get a cut December 10th. Okay? Wall Street wants to know the game plan for 2026 and what to, price in. And we just don't have a lot of certainty there. The expectations are all over the place for 2026. But the fact of the matter is, we do have the best possible scenario playing out for risk assets into the end of this year and 2026. That is a decent economy that likely gets better next year. That is inflation that probably continues to trend lower. Obviously, we'll see there. I think the actual inflation situation in the economy has gotten dramatically better. I don't really think there is active inflation out there the way that the CPI data calculates it. It looks like there is, but there's really not a huge inflation problem. So I think the consumer gets better. I think the real estate market gets better next year. That's going to be really good for the consumer, economy, and risk on area. But as inflation comes down next year, you'll likely get a couple more rate cuts. And that is the best possible scenario for risk assets. Strong economy, rate cuts, new Fed, better liquidity from lower treasury yields, presumably, right? Best possible scenario for risk on assets. And that is why I've been buying that area of this market, especially considering the AI trade is alive and well. There's really nothing to complain with the AI trade. Okay, it's going to be with us for a long time. There has been fears of like an AI bubble, and what Michael Burry has said recently, calling Nvidia Cisco in 1999. We had Meta yesterday that said they're potentially going to buy Google chips, although I don't believe that. It is putting pressure on the AI trade. Okay, a lot of your AI stocks are down today, but a lot of them are only down like 1 to 4%, 1 to 3%. It's not a really bad day out there. It's kind of like a just, we'll try this again on Friday kind of day. They're not surging like the index, but they're not crashing either. There's definitely a bit of stabilization in the risk on trade. This even goes for larger companies like Tesla. I mean, Tesla's up 0.3% today, but it's not performing like your other Mag 7 stocks or like a Dollar General that was up 4% today. Okay? There is still that little bit of nervousness, but once we get over that, what you're going to see is staples, and the areas that are outperforming now are going to take a back burner role, and then you're going to see the risk on resurgence into the end of this year, especially once we get to the Fed meeting and then get more economic data. I think Wall Street just wants a little bit more in terms of the economy, what's happening with inflation, so we can have a better understanding of what to expect next year. Because let's face it, nobody cares about 2025 anymore. It's all about 2026. And for that, we just don't know what's really happening right now. We know we're going to get a rate cut. We know the economy's doing okay. But there's really, what's inflation doing? I couldn't tell you what CPI is doing. Nobody could tell you what CPI looks like right now. And that's important for that risk on trade, for that AI trade to really thrive. NVIDIA's CEO Jensen Huang today is urging employees to use AI as much as possible and says they shouldn't fear that doing so will cost them their jobs, per Bloomberg Intelligence. Huang was reportedly stunned to learn that some managers were discouraging constant AI use. During an all-hands meeting, he pushed back hard. He said, quote, "My understanding is that NVIDIA has managers telling their teams to use less AI. Are you insane? I want every task that can be automated by AI to be automated." The U.S. Trade Representative today has extended the 178 product exclusion from the Section 301 tariffs on China related to technology transfer, IP, and innovation practices. These exclusions were set to expire on November 29th, but will now remain in effect through November 10th, 2026. The extension follows the U.S.-China trade and economic deal announced by President Trump and President Xi Jinping on November 1st, 2025. Public comments were received and direction from the president. Here we have a headline that says AI-driven growth could keep the U.S. economy strong enough to temper expected Fed rate cuts next year. While markets price in up to 3 cuts, McKinsey's Dustin Reed says faster growth from AI may require tighter policy, pushing Treasury yields higher. He expects the 10-year yield to reach 4.4% by mid-2026, up from 4% today. El Arian on CNBC today says Fed guidance should be stable. Mohammed El Arian called recent swings in rate cut expectations from 90% to 30% and back to 90% crazy. He said forward guidance should ensure predictability and stability for both the U.S. and global markets. Fed officials, he added, should provide a strategic outlook, not commentary that fuels volatility. So maybe on December 10th, we get more of a stable outlook, something that doesn't cause volatility as much like the last Fed meeting did. Now, in other economic data today, we did get the Chicago PMIs for November that came in pretty shocking. It came in at 36.3 versus the forecast of 46. So it came in 10 points lower than expected, which, it's not a super important economic data set, but it's like, what the hell is that, right? It's kind of shocking. JP Morgan says they are bullish on the 2026 stock market. JP Morgan strategist Lokos Bugis sees the S&P 500 hitting 7,500 by year-end 2026, driven by strong earnings, AI growth, and expected Fed rate cuts. If the Fed eases further, the index could surpass 8,000. Despite recent AI stock dips, JP Morgan highlights Amazon, Nvidia, and Google as likely outperformers next year. And U.S. jobless claims declined to the lowest level since mid-April. So, again, that's just a little stronger than people thought, putting what I believe some pressure on that risk on trade from, Wall Street wants more certainty on 2026, right? Wall Street saying right now we could get 3 cuts or we might not get any cuts if that kind of, data continues. So it's putting a little bit of pressure on that risk on AI trade today. Per CNBC today, it says professional investors have been using the market's record-setting run as an opportunity to take profits, while retail investors have been doing much of the heavy lifting in the latest run of the 3-year-old bull market. And this is one reason why you're probably going to see a year-end chase, okay? Because Wall Street has been underperforming. They underperform pretty much every year versus the S&P, and that's not a good look heading into a new year, okay? Wall Street doesn't want to be underperforming the S&P and underweight stocks. Say the S&P's up 14% this year and they're up 8%, that's going to cause a chase. Bank of America today is turning cautious on the S&P. They see modest S&P 500 returns in 2026. They say the S&P 500 will reach 7,100 in 2026, about a 5% gain. They say that 14% earnings growth is in store, but that liquidity support is fading with fewer buybacks, higher capex, and limited central bank cuts ahead. It projects a wide 5,500 to 8,500 range for the index. So basically they're saying next year could be really bad or really damn good. Doesn't tell you a whole lot. At the time of recording this video, Tesla's stock is up around 0.5% today, trading at about $421 per share. From a technical perspective, you really want to get above the 50-day moving average here at about $433 a share. I'm going to call it $435 per share as kind of that psychological level. Once you get above that in the coming weeks, which I think we will in my opinion, that's where things could get explosive to the upside. And I think really what you're seeing in markets right now is, again, some areas that are leading out of this recovery that's going to transition into the areas that are lagging, right? You're going to see this rotation from the staples and the, very predictable earnings, your other Mag 7 stocks, into more of the hyper growth, higher beta stocks into December. And that, I believe, will favor Tesla. The only way that does not happen, in my opinion, is if the economy just looks so strong on December 16th when we get your jobs reports and some of your survey data, and it looks like we're not going to get like any cuts next year, something like that. If inflation comes in too hot, or if the Fed, like on December 10th, really throws doubt on any other Fed rate cuts. Something like that, like another surprise event in December. As long as we don't have any huge shockers, you're going to see the higher beta trade come roaring back to life. And in all reality, you want a strong economy. You want the AI trade to be strong. You want Nvidia earnings to be good. We've gotten a lot of good news recently. And I think one of the major problems that hasn't been talked about much has actually been in the crypto markets with liquidity. And that's really helped dry out the liquidity in the higher beta areas. And, you get crypto coming back, you get a little more certainty on the economy. AI trade is alive and well. Consumers doing okay with likely strengthening next year. And inflation makes progress coming down. And you're in for a pretty damn aggressive rally into the end of this year and Q1 of 2026. Now, let's get into some of your Tesla stock news today. The largest Tesla supercharger in the world is now fully open in Los Hills, California. This thing is wild, with 164 total charging stalls, and it's totally powered from 10 Tesla Megapacks with solar. So it's a self-sustaining Tesla supercharger with 164 charging stalls. Max on X, he has been building superchargers since 2014, says solar and megapacks are needed to meet electrification and data center demand. This supercharger is evidence of that. Tesla is now also running paid advertisements on X about FSD. And this is the big news that Elon Musk dropped today. Elon Musk says that the Tesla robotaxi fleet in Austin should roughly double next month. Now, what's also interesting that markets did not react to at all yesterday is it was confirmed that in Nevada, Tesla has actually received the main approval to begin robotaxi operations. They are now legally allowed to transport people autonomously in Nevada, but they need the permit to essentially charge people for this, right? Which is, I would say, the lesser of the two in terms of the approval process to begin robotaxi operations. So Las Vegas could be coming literally any day and come online for the robotaxi network, which, you'd think Wall Street would have reacted positively to that. You would think Tesla doubling the robotaxi fleet in Austin within the next month would be seen as positive for Tesla. And I think normally it would, but when these broader market forces are in play, with the risk on trade just not catching a bid, again, it's why we're finding so many deals out there. Some of these hyper growth AI stocks trading at dirt cheap valuations. We're talking less than 2 times sales for some of the stocks that we have been buying recently in the trading community that are growing, projected to grow at 300 to 500% next year, trading at less than 2 times sales. High margin software businesses, they can't catch a bid even with all their good news that they've had. Tesla can't catch a bid with all of the good news that Tesla has had, until you see the flip-flop in sentiment in this market, which I believe happens in December. Now, Tesla China VP Grace To has released a statement after the Wall Street Journal reported this month that Tesla has been requiring suppliers to exclude China-made components in its manufacturing of cars in the U.S. She says, quote, Tesla values the role of China-based suppliers and does not exclude any of the basis of country of origin or geographical location, whether in the United States, China, or Europe. Tesla applies the same strict and objective standards for selecting suppliers across its global production facilities. Tesla's Shanghai facility achieved the lowest prices globally for consumers in China to buy its Model 3 and Model Y with the help of more than 400 domestic suppliers. More than 60 of them also supply Tesla globally. Agarwal, I probably just butchered that terribly, that joined Tesla earlier in November, which was previously the head of Lamborghini in India, is telling their Indian buyers that Tesla's low running cost, including maintenance and fuel, can help Indian buyers to recoup about 1/3 of the Model Y's $67,000 price tag over 4 to 5 years. Tax for electric and hybrid vehicles has been announced by the UK government. Starting in April 2028, electric car drivers will pay a road tax of 3p per mile, about 4 cents. While plug-in hybrid drivers will pay 1.5p per mile, with rates going up each year with inflation. So under the measures, an electric car driver clocking up 8,500 miles in 2028 through 2029 fiscal year is expected to pay about $337. That is crazy, because I've driven like 20,000 miles in the last year. So what? I would have been charged like $700-800 on top of the other taxes and charges. Just, every birthday you gotta go, renew your tags and all of that. That's crazy to me. And also in the news today, the 1,000th supercharger stall is now open in Italy. In option activity today, it is slow. It is the day before Thanksgiving. There's not a lot of people in the office. There's not a lot of people trading right now. You have 79 different trades from hedge funds and institutions, totaling $46 million with a positive order value of 87%. So it's very bullish, but a super low dollar amount. You do have 567,000 shares that are being covered on today. The estimated short interest sitting at 3.01%, with about $32 billion sold short in Tesla and about 75.5 million shares sold short. This is down from about 79 million shares that were estimated sold short about a week ago. So there's been some shorts that have been covering on short positions. Over on StockTwits today, sentiment for Tesla is neutral at 54. That's actually better than yesterday. You were neutral at 45, so increasing about 9 points there. Message volume is normal at 45, unchanged from yesterday, and the participation ratio is low at 38. And again, I just want to really encourage you guys to pay attention to the news coming out of Tesla or some of these other stocks, some of the good news we've talked about in the past couple of weeks, and then pay attention to what's happening in the markets. Okay? When the markets are feeling a certain kind of way, when they're not giving credit to certain areas, like right now, like today, the last couple of weeks, it's been nobody gives a rat's ass about the AI trade. The small cap hypergrowth AI trade, which Tesla falls into that hypergrowth category, not necessarily the small cap category, but the hypergrowth category. Wall Street just says, I don't care what happens. You want to pay attention to what is happening in the companies you're investing in, because when the sentiment flip-flops, all of a sudden, all of the news that we've covered in the past couple of weeks will come back and be a positive catalyst for the stock. Okay, you do not want to ignore the news and just say, oh yeah, Tesla doubling robotaxi operations in Austin. That doesn't matter, because the stock's not reacting to it today. The stock will react to it. The question is when, okay? And I think the situation is about to get better for the risk on trade. We have the perfect setup here. Just a little bit of uncertainty still out there. Again, what's the perfect setup? AI is alive and well. Use cases are growing. Applications are growing. Investment is continuing. We have a better than expected economy. We have a Fed rate cut December 10th, but there's uncertainty how many rate cuts we're going to get with this better than expected economy. There's uncertainty around inflation. A lot of people think the only thing that determines what the Fed is going to do is how the economy is doing, or what the Fed's going to do with their rate cuts. No, the other side of that is inflation. If inflation comes down and economy remains stable, that also means the Fed would be more inclined to cut rates. Okay? A lot of people forget that. And there's a lot of uncertainty there. What's inflation doing? So, into December, things are likely to get much better for the risk on trade, especially for 2026, because things look really good for 2026. And we'll talk about that in the next video. Do me a quick favor, ladies and gentlemen, hit that like button as well as subscribe to the channel if you have not done so already. Check that link out down below in the description of today's episode if you guys want to come join the trading community. With that said, have a great rest of your day, and I will see you in the next one.